and welcome to Global Economy Explained. In this weekly stock market outlook, we take a calm and unbiased look at what happened in global markets this week, what investors are paying attention to, and what signals truly matter, without hype, noise, or predictions. This past week, global equity markets remained largely range-bound. Major indices showed limited movement as investors balanced mixed economic data with ongoing uncertainty around interest rates and global growth. Rather than reacting strongly to daily headlines, markets appeared to pause and wait for clearer direction. This kind of behavior does not usually indicate weakness. Instead, it reflects indecision. Capital is still present in the system, but investors are cautious about increasing risk exposure until more clarity emerges. One of the most important factors influencing market sentiment continues to be inflation. While inflation has come down from its peak levels, the pace of improvement has slowed. This has made central banks cautious and has prevented markets from confidently pricing in aggressive interest rate cuts. Interest rates themselves remain the most powerful force shaping market behavior. Higher borrowing costs continue to weigh on valuations, particularly in growth-oriented sectors. As long as rates remain elevated, markets are likely to stay selective rather than broadly optimistic. Global economic growth is another key variable. Some regions are showing resilience, supported by consumer spending and stable labor markets. Other regions, however, continue to struggle with weak demand and tighter financial conditions. This uneven growth picture is contributing to cautious global sentiment. From a sector perspective, investor behavior suggests a preference for stability. Capital continues to flow toward companies with strong balance sheets, predictable earnings, and consistent cash flows. Highly speculative assets and momentum-driven trades have seen reduced participation, reflecting discipline rather than fear. It is important to note that there are no signs of panic selling. Markets are not under stress. Instead, investors are being selective, which is common during periods of economic transition or late-cycle conditions. Professional investors are currently focused on signals rather than stories. They are watching inflation trends, central bank language, labor market resilience, and the sustainability of corporate earnings. Rather than reacting to individual data points, institutions are looking for confirmation across multiple reports over time. This explains why markets may appear quiet on the surface. Beneath that calm, information is being processed continuously, and positions are being adjusted gradually rather than dramatically. The key takeaway from this week is simple. Markets are stable, but cautious. There is resilience in the global economy, but confidence remains conditional. Investors are not rushing to take aggressive positions. They are waiting for clearer signals. Periods like this often reward patience, discipline, and long-term thinking, rather than short-term speculation. That concludes this week's Market Outlook from Global Economy Explained. If you value calm analysis over noise, consider subscribing for weekly insights on markets, inflation, jobs, and global economic trends. Thank you for listening, and we'll see you next week.